All right, Dupree, going to talk with you about another topic that's on everyone's mind, and that is rising interest rates. How's that impacting the industry, and what do you see going forward?
Well, it's a challenge for sure, I think, especially on the buy side. But what our industry is dealing with that I think is unique is you have, and when we just went through COVID, you have a ton of liquidity that came in the market. You have a ton of people that have now raised funds anticipating distress during the pandemic that didn't really happen. So then when interest rates go up, the expectation now after what we just went through is that you're going to start to see banks want to take assets back. But the reality is that no bank wants to own a hotel for one. But even if they do, there's a floor that's been created just by the amount of liquidity that's coming into our market. So because there's so much equity that's been raised, it will create a floor that really will set pricing above where a distressed mark will come. So I think it's one of those things where the deals that are going to get done right now, in my view, are going to be REITs because they don't need debt. And then the sponsorship groups that are just exceptional, I think they're the ones that are going to be able to get debt in this type of market. But one way or the other, something's got to give. Pricing, if you're underwriting an asset, CapEx pricing, you're pricing your renovation, that's going to be up by probably 20%. You're going to have to underwrite some type of softening that's happening over the course of the next year or two. The only thing that gives is returns. And so the reality is, like, with the amount of equity that's coming into the space, it has to be something where that equity is willing to say, we'll just take a lower return. I don't see any other way to get there. In fact, unless we're doing it wrong, that's the way we're looking at it.
I mean, that's the way the math works. And I think Dupree is right. Look, I'll go on a limb as an intermediary and say this. I do feel like we are seeing a secular shift in rates and where rates will be. I've told our junior people that maybe weren't around before the GFC and quantitative easing. The past 12 years of quantitative easing is the exception, not the rule. We're just going back to the way things were before, where you had treasuries 4%, 5%, and even then, I mean, if you compare that to the 80s and 90s, that's still low. So, a Fed funds rate at 4.5% or 5%, while shocking to people that, haven't been in the industry for a long time, that's where things were. I remember back in 04, 05, I mean, we were doing hotel loans at 5.5%, 6%, 6.5%, and owners were making money, lenders were making money, so you can exist in that environment, but credit spreads were different, right? So that's the one thing that has to change. So to Dupree's point, we're seeing a secular shift in the pricing of debt. We haven't yet seen that shift in the pricing of assets. And so at some point, something has to give. I mean, and to John's point, I mean, they're in the market with an amazing portfolio right now. And I know, I mean, it's full pricing, right? But it's forever assets, and people are saying, I just want to own this. It's recession-proof. And so there's a bit of a disconnect here. But so in my opinion, the next 6, 12, 18 months are going to be incredibly fascinating to see how this dynamic plays out.
Yeah, I don't know. I mean, the price, we've seen some repricing. It's usually 5 to 15%. And so other asset classes, I think, have seen upwards of 20% repricing in assets because of this interest rate movement. When we look out 6 months, I think the spreads have to come back in. These lenders have to start putting out money again. Their balance sheets are generally in good shape. So while the index is up, I think the spreads will, I hope, I'm not trying to predict which way interest rates are going, but I hope the spreads start to come in. And to Kevin's point, there's a long run of history where people in the hotel business have made money with expensive, like debt, much more expensive than other asset classes. And people just got punch drunk on, free money basically for the last decade. Yeah. So, again, on this portfolio we're selling right now, we've got REITs and family offices that have said, we're just going to take it down all cash. And these are several $100 million assets, or they'll get a signature loan from their private wealth management group, and so they're able to manufacture, a high single-digit return on it. And that's okay for them, because they just want to own it forever.